Sometimes the most boring market sectors are amongst the best places to build long-term wealth. I'm not talking about tech, biotech, or AI. I'm talking about railroads and shipping. It's unglamorous, but it's behind-the-scenes businesses that focus on basic ongoing needs, getting stuff from here to there. Warren Buffett figured this out back in 2010 when he paid $44 billion for Burlington Northern Santa Fe, one of the largest freight railroad networks in North America, and locked it away inside Berkshire Hathaway forever. This has been a glorious investment over the years. The principle behind the trade, to own the infrastructure the economy cannot function without and then hold it forever, is available to you right now in 3 other stocks that most investors have never heard of. Today, I'll share all 3 with you. I'll tell you exactly why it fits Buffett's playbook and how the fundamentals prove out the virtue of these long-term investments. If that sounds good to you, then please give this video a like, as it tells me to record more topics like this in the future. And by the way, I'm Steve Reitmeister. I spent nearly 20 years as the editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen, where our proprietary Zen Ratings model analyzes roughly 4,600 stocks by 115 different factors every single day. The model gives a final analysis with an intuitive A to F grade. This makes it easy to find the stocks most likely to outperform. And a quick note, I'm giving you real stocks and data today, but any investment decisions you make are yours and yours alone. So do your own due diligence before buying or selling any stocks. Okay, the speech is over. On to the good stuff, starting with stock number 1 in Star Bulk Carriers with a symbol of SBLK. Here's the Buffett playbook in its simplest form. Find the infrastructure the global economy cannot function without, buy it at a discount, enjoy the benefits for years to come. In terms of fleet tonnage, Star Bulk is the largest dry bulk shipping company in the world. Their vessels haul iron ore, coal, grain, cement, and fertilizer, the same essential commodities Buffett's railroad company moves across America, except Star Bulk moves them across oceans. The macro setup here is strong. Fleet supply is tightening. Fewer new vessels are entering the market than at any point in the past decade. Less supply plus steady demand equals higher charter rates that flow straight to the bottom line. Let's look at some of the company's attractive attributes. For example, in the most recent quarterly earnings report, they showed 72% earnings growth year over year. That was a nice bounce back from a soft year last year. Okay, gladly. Wall Street analysts expect the growth party to continue for the next few years at about 25% per year. Yet even with the growth, investors are still not paying up for shares in proper order. This shows up clearly in the ultra-low 0.39 PEG ratio. Anything under 1 screams value. Now, I should also note that the forward dividend yield is 6.24%, about 4 times better than the average S&P 500 stock. Analyst coverage for this name is very thin, but that may be a good thing. Thin coverage often means the market hasn't caught up yet, thus creating an under-the-radar opportunity. As for the Zen Ratings model, Star Bulk grades an overall A, which amounts to a strong buy recommendation. That's because it ranks in the top 1% of all stocks based upon its strong fundamentals. The overall Zen Ratings is the sum of a 115-factor review, organized into 7 different component grades. Now, each of those components has its own unique A to F rating, so let's look at that and see what other insight we can find out about Star Bulk. Star Bulk earns above average B grades across 6 of the 7 component grades, including value, sentiment, financials, growth, and AI factor, and momentum. The last 2 point to the most timely stocks. That means it scores in the top 20% of a wide range of categories. That lack of weakness is indeed a strength that likely points to future outperformance for the shares. One risk worth noting is that dry bulk rates are historically cyclical, and the next downswing for rates will quickly hurt earnings and the share price. But let's remember the current supply-demand imbalance favors higher rates for the foreseeable future. This benefits Star Bulk, with the world's largest fleet pointing to an appealing growth and value story, not to mention a juicy dividend. This is Buffett's infrastructure playbook on the open seas. If you want attractive stock setups landing in your feed every week, then please subscribe and turn on the notification bell. That's because I publish deep dives like this several times per week, and it's the best way to ensure that you don't miss my next one. Next up, we have LB Foster Company with a symbol of FSTR. Here's something to consider. Buffett didn't just love railroads because trains are interesting. He loved them because the physical infrastructure underneath them is irreplaceable. Nobody thinks about who supplies all that, and that's exactly why this pick is so interesting. LB Foster is a manufacturer and supplier of engineered products for railroad infrastructure, rails, fasteners, the plates, and condition monitoring technology. Every mile a track runs on products like theirs. This is the picks and shovels play on the infrastructure Buffett spent $44 billion to own. The major freight railroads are in an active capital expenditure cycle right now, upgrading tracks, expanding capacity, and modernizing the infrastructure. L.B. Foster sits directly in the path of that spending, and as long as the cycle continues, the demand for what they make keeps growing. That's not a thesis built upon momentum. It's a thesis built on a structural spending trend that is still in the very early innings. Now, here's something you should know. Earnings were down last year as the company invested heavily in its rail technology segment. That is part of the trade-off at this stage of the growth cycle. This was likely a wise move by management, as now they are set up for a multi-year run of earnings growth averaging 50% a year according to Wall Street analysts. All this fundamental goodness is showing up in spades across the Zen Ratings model. Again, we have an A-rated stock overall, which implies a strong buy recommendation. That's because they score in the top 3% of all stocks across that full 115-factor review. It's also the number one railroad industry stock in the entire database. Looking into those component grades, they score highest in the following areas. We're talking about top 15% of all stocks for sentiment, top 8% for momentum, and top 5% for growth, which is the best indicator of likely more earnings beats ahead. True, the historical earnings volatility is real, and this is a small cap name which adds to the share price volatility. But those should not detract you from the overall investment thesis. If the railroad CapEx wave continues, Foster is one of the most direct ways to own it. This fact should make it worthy of serious consideration for your long-term portfolio. Now, before I get to the last stock, I want to invite you to join me for a live training session this coming Monday at 7 p.m. Eastern Time. That's when I share my updated market outlook, plus my trading plan to beat the market, as well as the top 7 stocks for the week ahead. In these live training sessions, you truly get the best of the Zen Ratings, my greater than 40 years of investing experience. So be sure to join me this coming Monday at 7 p.m. It's totally free. Just sign up at WallStreetZen.com/live. You'll also get a link in the description below or scan the QR code on your screen. Look forward to seeing you on Monday. Back to the stocks. I saved the best one for last in Pangea Logistics Solutions with the symbol of PANL. The reason this one closed the list is that it does something the other two don't. It doesn't just move the freight, it owns the infrastructure the freight moves through. That's the Buffett investment thesis at its most literal. Pangea hauls ice-class cargo, bulk commodities, and break bulk freight across global trade routes. The difficult freight that most carriers take a pass on. But the real story is what they're building on shore. Pangea owns and operates port terminals, and they're actively expanding them. They don't just move the freight, they own the infrastructure it moves through. The benefit of which showed up in the 54% earnings growth last year. That was a welcome response to a brutal few years where shipping rates normalized and most operators pulled back. They kept building terminals, kept expanding infrastructure, and used the downturn to quietly position themselves for the next leg up. The 5.1% profit margin looks super thin until you understand why. This company has been deliberately reinvesting into its own port terminal infrastructure. As those terminals come fully online, that margin expands, and the investors who are already on the stock benefit from that inflection before the rest of the market even takes notice. Additionally, Pangea pays a hearty 2.64% dividend yield, which has grown consistently over the past several years. For a company that is still actively building out its port footprint means you are participating in a long-term growth story at the earliest possible stages. That is a tried and true investment plan that often leads to years of outperformance. One of my favorite parts of the Pangea story is the heavy insider buying. Insiders are net buyers over the past 12 months. Multiple directors added shares in February at prices above current levels. Now, when the people running the business are putting their own hard money to work, it speaks volumes about what they expect in the years ahead. Once again, the Zen Rating smiles on the stock with an overall A rating. Even better is that it scores in the top 1% of all stocks we cover. This also makes it the number 1 ranked stock in the shipping industry. Several of the component grades land inside the top 20% of stocks we track, but 2 truly stand out here. The sentiment grade of A, also ranking the top 1% of stocks we track, that's the smart money signal. We're talking about aggregating institutional money flows, insider activity, and analyst upgrades, and it's firing at the highest possible level. Value grades in A as well in the top 4% of all stocks, meaning not only are here you getting exciting growth prospects, but you also get to buy at a very attractive entry point. The risk is the same one I flagged at the start. Thin margins and rate cycle exposure are real, but Pangaea's own terminals give it a revenue base that doesn't fluctuate with charter rates the way the pure play shipping operators do. That's the structural advantage that separates it from the rest of the pack. Combined with the fundamentals and heavy insider buying, this is a strong one to consider at this time. Now, I want to hear from you. First, are you attracted to the long-term investment appeal of railroad and transport stocks at this time? And which of the three stocks has the greatest appeal to you and why? Please share your thoughts in the comment section below for the benefit of our community. Please don't be shy. And if you want to continue researching long-term investment ideas, then I suggest that you watch my video featuring stock investors will wish they owned 10 years from now.